Welcome to my second video session for the Principles of Accounting class. I'm Professor Stephen Atchley, as you probably already know. And today we're going to discuss chapters 3 and 4. Chapter 3 introduces the double entry accounting system. This is the formal system that is used by most accountants. Most businesses use double entry. Up until now, in the first two chapters, we've just looked at single entry accounting, but now we'll get the entire subject under control. Okay, double entry bookkeeping is an amazing invention. It's actually quite ancient. In 1458, a man in Croatia named Benedict, his last name I can barely pronounce, so I won't mangle it, wrote a book called Book on the Art of Trade. Sounds like Trump's book, The Art of the Deal. But in this book, although it's very slim, he introduced the idea of double entry bookkeeping, and this really changed civilization in some interesting ways, because now not only could business people keep track of every single penny of transactions, but they could also analyze the productivity of their different assets and even evaluate the risks of different types of enterprises and activities. So this gave our civilization the ability to use our resources more efficiently, to produce more, to enjoy a higher standard of living once it was widely spread and understood. We start this chapter, and as I go through them, I will just give you some page numbers of things to study. We're going to start with debits and credits on page 124, and this is a longer section. It goes to 123. And basically in this section you'll review the accounts that you're already familiar with, and we'll look at what they look like when they're portrayed in a double entry system. And of course the double entry refers to the terms debits and credits. These mean left side and right side of the account. If you're looking at a T-shaped account, left side is called the debit, the right side is called the credit. Many people know approximately what this means, but they often confuse it with increase and decrease, which is not what it means at all. So study the debits and credits section, and then we will proceed to page 133, where you will look at the general journal and the ledger of accounts. The general journal is just that. It's like a diary. It records every transaction that the firm undertakes from its very beginning in chronological order. It is also called, often by accountants, the book of original entry, because that's where you originally record the information from your receipts and business papers and contracts and so forth. The ledger then is the collection of all the accounts of the firm, and as I said, we'll identify a couple of dozen of those at the beginning, and we won't wind up with a very large number at the end either, maybe 4 or 5 dozen tops. These accounts, the collection is called the ledger. It's also called the book of final entry, because the information in the general journal is recopied in the accounts so that we can keep track of the individual items, assets, liabilities, and ownership accounts individually. So the journal gives us the chronology, when did this happen, what was involved, and then the accounts contain the actual amounts and are cumulative. That means they add up over time to whatever totals we're going to be looking at. This will cover page 133 to 137, so a shorter section, just 4 pages. Take a look at that and you'll have a better understanding of those two elements of the accounting system. The last part of the accounting system that we will encounter, major part, is the closing, and periodically, that means once a year or oftener, but on a regular schedule, accountants will close out the books, the temporary accounts, move the totals to permanent accounts, and start fresh. I think I used the analogy of an odometer in class. The odometer keeps track of the miles your car has traveled from the time you've had it. The trip meter, I personally use it to keep track of my gasoline usage. So when I buy gas, I reset the trip meter, then I know how many miles I can drive before I have to purchase gasoline again. That way I don't get caught on the road short of gas. Really embarrassing thing to happen. Hasn't happened to me in about 40 years. How about you? If you're laughing, that's great. I'm laughing with you. It's happened to me before as well. So the accounts are closed, and the the first thing an accountant does is takes a trial balance. So the trial balance will be explained on page 137, and as you read ahead over the next 4 pages up to 141, you will see that the trial balance simply consists of all the accounts in the ledger and all their balances, and the accountant will add them up, debits and credits, and if they're equal, it is a one step in assuring that the accounts were properly entered. It's not foolproof, but it is a great help. Once upon a time, this was done by hand with calculators or pencil and paper. Nowadays, the computer makes it virtually instantaneous. After taking a trial balance, the accountant will then divide the accounts into the various reports. And we'll take a look at the financial statements again, the balance sheet, income statement, cash flow, and equity statements one more time. We close Chapter 3 with a little look at financial analysis. Financial analysis is simply the idea of how do you interpret these numbers that the accounts have collected? How do they compare with other firms in the same business, other firms in different businesses or industries? And we can gather a little bit about the actual performance of the company, its stability, its longevity, and so forth from these financial analyses. It allows us also to make effective use of our assets, so we're not devoting assets to unproductive uses when they could be used in far more productive ways within the firm itself. It also allows us to measure our profitability and perhaps most importantly to assess the risk or riskiness of different investments so that we aren't undertaking undue risk. Of course, in business, you know that risk reward is the general rule, meaning the more risk you undertake, the greater the potential reward. Of course, if the risk comes true, you fail, and there's no reward at all, you lose a lot. So we like to maintain or control or manage, is proper word, manage risk to keep it within acceptable limits. And every business, every entrepreneur, every owner group has a different level of acceptable risk that they will undertake. This concludes our first chapter for the evening, and then, or for the week actually, and then chapter 4. Excuse me while I turn pages here. And sorry about the screen. I'm recording this on an iPad, and it's a little bit difficult to maintain proper angles, so forth. So it bounces around a little bit, and maybe that'll keep you entertained. There's also some very distracting material in the background, and I'm trying to keep that out, but it's not working too well. I'm sitting in front of a bookshelf, and you'll see all kinds of wonderful Catholic icons up there, saints and angels. Don't let them disturb you. They're your friends, I hope. They're mine. Let's move on. Chapter 4, Accounting for Merchandising Businesses. Up until now, we've looked at service-type businesses, and a merchandising business, instead of producing a service, purchases a product or good from another business, manufacturer or distributor, and then does something to make it more valuable, maybe moves it somewhere so that it's accessible to customers, and then resells. The key activity included in merchandising businesses that we haven't encountered yet is inventory transactions. So we start on page 190, and the first 2 pages will talk about accounts which we use to manage changes in inventory, acquisitions, use, and so forth. Those accounts are called the cost of goods, or they reckon the cost of goods available for sale. We have 2 accounts in particular, the merchandise inventory, which is just simply the value, dollar value of the merchandise that we have available for immediate shipment upon order. This is an asset, of course. And the second would be cost of goods sold. After those inventories are taken out and shipped, they're an expense, and so we record them as such. There's also, on these 2 pages, a lot of material here in a short space, a perpetual inventory system. And perpetual inventory is a very effective way of keeping inventory. It's highly accurate, and it's very, very useful in managing taxes and other kinds of events that we'll talk about later. But just take a look at what it consists of. And then in the second part, we're going to look at the effects on the various accounts. So for 3 pages, page 192, 193 to 194, 195, I guess that's 4, We'll look at the accounts and how changes in the inventory actions involving our merchandise, how those affect the various accounts. Not just the merchandise accounts, but other related accounts like cash and equity and so forth. In the third part, we take a special look at merchandise-related activities, and these would include transportation costs or shipping, returns and allowances. Every firm that sells to the public has to be prepared from time to time to accept their merchandise back. It's part of doing business. How do we account for that? And finally, discounts, cash discounts, and other types of discounts. How do we account for those transactions when they take place? The fourth part starts on page 201 and goes on to 203, and we'll take a look here at recognizing gains and losses. We talked about this in the first chapter. We said there are 10 categories, and we'll look at 8 of types of accounts. Well, these are the last 2, and we said we'd cover those at a later date, and this is that later date. A gain or a loss is simply a proceeds from a sale of an asset are greater than a gain or less than a loss than we had expected and had allowed for in the accounts. So these are adjusting entries that must take place to reflect the true nature of things, and the IRS is very careful about these because they represent opportunities for taxation. We'll also take a look at a multi-step income statement. Previously, we looked at the simple income statement. We start with revenues, subtract all expenses, and we reach what's called the bottom line, profit, or in bad cases, loss. The multi-step income statement deducts the different accounts, expenses, according to their type in stages. So selling expenses, general administrative expenses, and direct expenses are separated into different categories. It can also divide the revenue into multiple segments depending on whether they're operating revenues, financing, or investment. Not all firms have investment revenues, but most will have operating revenues and including financing revenues. So we put these in different steps. Take a look at the organization of that file. And then finally, we hit the last 2 topics. The first is what's called common size financial reporting. Normally, the reports that we turn out have dollar amounts. For a big company, those will be big amounts. For a small company, much smaller. Those are difficult to compare when there's a big discrepancy, so what we do instead for comparison purposes is record each line item as a percent of the total report. This allows us to compare percentages and makes a big firm comparable with a smaller firm. Finally, we look at ratio analysis, and this is one of the tools of financial understanding, prognostication, whatever you care to call it, that allows us to determine the firm's operating health. We're going to look at 3 ratios in here: gross margin, net income percentage, and return on investment. And each of those is simply a fraction, one amount divided by another, those amounts taken from the accounting record. Finally, there is an appendix. It's not included in your testing materials. It's not really part of the course, but I would like you to take a look at it. It's called the periodic inventory system. It's an alternative to the perpetual system. It sacrifices a little bit of accuracy, but in exchange you get a whole lot of convenience and save a whole lot of time when keeping inventory records. So this is something just to take a quick look at. Well, that concludes our remarks for this week. Hope you had a great Labor Day, and that you had a wonderful celebration with friends or family, or just a little quiet time maybe to yourself, and that we'll return to class not this week, but next. And of course your homeworks are due on schedule as published in the syllabus. Looking forward to talking to you further, and you have a great day. See you a week from now.